Last week, I received a comment and a question from one of my latest videos. And I thought it was such a good question, I wanted to make a video out of it. So I'm going to read to you the question and we'll go from there. So the question is, hey, thanks so much for the videos. But while calculating both offers in that video, you just multiply the cash flow with your multiple, which in this case, for that example, was 2 and 2.5 times cash flow, but you didn't seem to take into account the value of fixed assets and inventory. Great question. Well, today's video, I'm gonna answer that question. Thank you so much, PM, for your comment and your question. So in today's video, I'm gonna go over exactly what goes into the purchase price when you're buying a business so you're not fooled. Let's get to it. Everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by buying a profitable business, or if you are in the rat race as a W-2 employee wanting to leave it behind by purchasing a profitable business, then you're in the right place. And I'm going to encourage you to subscribe to my channel. Don't forget to hit the bell. You'll be notified every Thursday when new videos come out. So, what we're going to talk about right now, we're going to talk about fixed assets, intellectual property, inventory, working capital, AR and AP, or accounts receivable and accounts payable, and real estate. Okay, first, let's talk about fixed assets, which is the question, that was actually put on the comments section of this video. What you need to understand that assets in the M&A world, in the merger and acquisition world, assets have no value separate from the actual calculation of a multiple of selling discretionary earnings or EBITDA. Assets, they're assets that are required to generate the revenue, the very thing that you need, especially in an asset-heavy industry vertical like manufacturing. You need those assets to generate the sales. You don't have the assets, you don't have the sales, okay? So what you need to understand is that yes, we look at the balance sheet as business brokers when we're trying to create an opinion of market value, but the assets are incidental. So the assets are always included in the transaction with a few exceptions, which I'm going to go into in a little bit. So if you follow me, the assets are part of the deal. So how do we value, or what we call an opinion of market value? If a seller comes our way and they want to sell their business, what we're going to do is we're going to take the time to normalize the revenue, to figure out per the tax returns, the revenue, cost of goods, expenses, and net profit for the last 3 years. And we're going to ascertain an average selling discretionary earnings and EBITDA, okay? The difference between the two is it becomes more material as the business gets larger. But the smaller businesses, they will also almost always sell as a multiple of SD. So follow me. So a business, we're going to look at its ability to generate revenue, net income. The assets are as important to generate the revenue. Assets that are not generating revenue are in our world worthless. It's a liquidation, right? That's the worst case scenario. Assets, we're going to measure the assets and their ability to generate revenue and produce net income. The higher the net income, the more usable those assets are to the buyer. So a business that is worth, say, $100,000 worth of selling discretionary earnings are going to be a calculation of whatever industry vertical is specific valuation or multiple based on comparable sales, say that is averaging 3 times cash flow. So in this particular situation, a business that is generating $100,000 worth of selling discretionary earnings will be worth somewhere in the neighborhood of $300,000, maybe a little more, maybe a little less. It is presumed that in that $300,000, whatever assets are associated that are free and clear will be necessary to, they'll come with the purchase. Okay, so that's the first thing that you need to know about assets. Now, here's another thing that you need to know about assets. Assets are depreciable. They're depreciated every year. The life cycle of an asset could be anywhere from 5 to 7 years, except real estate. And I'll talk about commercial real estate later. But so the first year, the asset will be worth 15 to 20% less than it was. So imagine a business that is a business that has been around for at least 7 years and bought the assets at the beginning of the business, and it's been 7 years later, and the depreciation was 7 years. How much are those assets really worth now? They're worth zero. Yes, you may say, yeah, but they're still allowing the revenue to be produced because we're gonna squeeze another 10 years out of them. Great, but just like a resale car that loses its value 20% as soon as you drive it off the lot, assets unto themselves don't really mean much to us unless they're actually generating revenue and net income. So that's the first thing that you need to know about assets. Now let's talk about inventory. Now, depending on if you're in an industry that actually carries inventory, I know manufacturing is one of them. You have to have the inventory. If you're electrical contractor, if you're in the trade services, HVAC, you're gonna have some type of inventory on hand to do the work. How much inventory on hand will be determined about the usable life and how long it takes for the business owner to cycle through their inventory. Usually in most businesses, it'll be about 60 to 90 days worth of inventory will be included in the transaction, okay? So anything excess of whatever is predetermined between the buyer and the seller will be negotiated separately. So we'll negotiate the amount of inventory that is necessary to carry on for the first 60 to 90 days. Is it gonna be 60 or is it gonna be 90? That'll be to be determined, right? You're stuck and trying to figure out how to actually buy a business from watching all the videos, trying to connect all the pieces together. I think we should chat. If you have any questions or comments, want to get some time with me, I would love to help you in any way I can. You can either drop me a comment below or you can send me an email. My email will be in the description section of this video, and let's connect. There are situations in which it's only 30 days worth of inventory that is needed. For instance, if you have a restaurant that has perishables, you're probably not gonna need to keep on hand anything over 30 days. So you're probably gonna need the first 30 days worth of inventory because everything else you're gonna have to buy. In other industries, may be up to 90. So say 30 to 90 days. Now, excess inventory gets negotiated separately in the purchase agreement, in the APA. Now, what about working capital? Usually the rule of thumb with working capital is you need to have enough working capital for the first 90 days. Now, the bank, as they are doing their review of the loan, if you're going to go with an SBA lender, they're going to be really looking at who's going to be bringing who's putting up the working capital. Is it the buyer? Is it you, the buyer, who is actually bringing the working capital out of your savings, out of the home, HELOC in your home, or is it going to be is it going to be part of the purchase price? And you're going to have some working capital as part of the purchase price. So if you're doing a stock purchase, which I don't really recommend, but I've been involved in deals where their actual buyer is buying the stock of the seller. The seller's legal entity all the stock gets sold. And in it was a particular situation in which there was over $1 million worth of excess working capital. What is working capital? Is the difference between your current assets minus your current liability. Your current assets is cash, AR, and those are the two big ones. And your current liabilities are usually payroll and some credit card debt, anything that is due within a year. So your current assets minus your current liabilities, your AR minus your AP gives you your working capital. Okay. Now, in this particular situation, the working capital requirements were about $25,000. This guy had over $1,200,000, over $1 million worth of excess working capital on a stock purchase that got carved out, and the seller got to keep that because it was not necessary. That excess working capital was a windfall for the seller, which had so much excess working capital that needed to be removed because the buyer didn't need that much. That's when you have a business that is very profitable. And yes, truly, beauty is in the eye of the beholder, because the buyer was able to figure out that this business produces so much cash that it builds up the working capital. Okay. What about intellectual property? Now, intellectual property, it's such a nebulous thing. True intellectual property is something that is being copyrighted or patented. Now, if you are working with a seller and they actually have patented technology, they would have to be appraised and it could be priced separately. It doesn't happen very often because somebody claims that they have intellectual property, but they have not done the work to protect the IP with the USPTO, which is the US Patent and Trademark Office. So it happens very, very seldom. And yes, that intellectual property will be part of the deal unless it's something so unique that the seller spend $100,000 perfecting their intellectual property. In that case, it could be negotiated, but I would almost always include it in the purchase price. What about AR and AP? Now, all of that is negotiable. The AR, the seller may wish to keep. They're going to keep. If you're doing an asset purchase, you're not going to want the AP. The AP belongs to the seller. You can negotiate some of the AR, and all of that is negotiable, or the AR may actually go with the seller. You may actually buy the goodwill in the customer list and everything else, the website, the domains, anything that makes the phone ring to produce sales with the underlying assets that are necessary to generate the revenue, etc. Those are negotiable. Particularly the AR. Obviously, if I'm representing the buyer, I want some of that AR as working capital. Remember the whole thing about working capital, because somebody's got to put up the working capital. And it could actually make or break your deal if you didn't negotiate it right. All right, let's get to the last one, which is real estate. What about real estate? Now, typically, if a seller has a free and clear piece of commercial real estate which they own by an LLC and they rent to themselves, those are usually separated in the transaction. So we're going to do an opinion of market value and we're going to take the business itself onto the market and we're going to sell the real estate separately. Now, maybe 2/3 of our sellers will want to sell their commercial real estate, especially if they own it for a long time. And maybe 1/3 of the cases they will want to keep it and they will not want to have the buyer rent from them. If it only makes sense. Usually this happens when we're doing our opinion of the market value, when sellers actually have not done a very good job paying themselves market rent, and we have to do negative adjustments when we're actually at the bottom, when we're doing the adjusted EBITDA, because the seller should have been paying themselves market rent. And it can get kind of complicated, so I'm not going to get too much into that. But the real estate, what it does is, if the real estate is available for sale and you wanted to buy it, it helps you in the amortization of the SBA loan. So what it will do is, normal amortization for an SBA loan is 7 years on a cash flow deal. Okay, if you're strictly buying the business and an SBA lender is a cash flow lender and it's going to be mostly based on the cash flow that is generating as per the tax returns and the pro forma work that you're going to give for them, you only go up to 10 years. But what happens when you add the commercial real estate into the picture, it may be a different deal. It may be a 504 SBA loan for the commercial piece. It will be a 7A SBA loan for the business piece. But together, you're going to have a blended amortization. So it's possible, by the way, the commercial amortization could be 25 years versus 10 years worth of SBA 7A loan. So the non-real estate could be 10 years. The commercial piece, the real estate piece could be 25 years. So blended, you may end up with a loan that is 22 years. What it does for you, it lowers your debt service coverage ratio. It's actually a good thing because it lowers the threshold. The longer the time that you have to pay it, the lower your payments. If you're kind of on the bubble, if you're like 1.3 debt service coverage ratio, well, having longer amortization may actually shoot your debt service coverage ratio over 1.5 or more, which will make a win for everybody. So that's the thing. I hope that answers your question. And so much. If you have any more questions, please keep adding them to the comments on my videos and I'll keep making videos about it. Thank you so much for watching. A limited time, I'm giving away my cash flow calculator that has been downloaded hundreds of times, that allows you to calculate the cash flow on any deal you're looking at by putting in the projected debt service and figure out how much cash flow there is. After all, it's all about cash flow. So it is yours to keep. All you have to do is click on the link below and you can have it as a gift to you for watching my videos. Thank you so much for watching.